From New York City for our viewers worldwide, I'm Manus Cranny in for Jonathan Ferro. These equity markets have an irreverence to commercial real estate risk, and your event risk, and that's a bond market auction. The countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up on the show, investors brace for the next round of Fed speak. Secretary Yellen sounds the alarm on commercial real estate. And the latest U.S. border agreement is on the brink of collapse. We begin with the big issue. Fed officials fighting the doves.
It would be a mistake to move rates down too soon or too quickly without sufficient evidence that inflation was on a sustainable and timely path back to 2%. If the economy evolves as I expect, I think we will gain that confidence later this year, and then we can begin moving rates down.
Has been surprisingly good news. Again, I don't want to say we're done yet. I don't want to say we're necessarily going to just glide past all the way to 2%, but fingers crossed, the data is looking positive.
A lot of Fed speak to absorb. My guest this morning, Winnie Caesar of Credit Insights BlackRock's Marilyn Watson. Good morning, ladies. Here we go. Day two of Fed speak drama. I'm drawn to master. The mistake is to move rates down too soon or too quickly. I look at the movement in bond markets, and I want to know what you think. 8 basis points down yesterday. Was that yield hunters arriving for the 3-year paper, Marilyn, or was it nerves about New York Bank Corp? Good morning.
Good morning. Good morning. Yeah, we've certainly seen a little bit more volatility in markets, obviously, over the past few days, given the wide variety of news that we've seen. So I think in terms of Fed speak, this is really a continuation of the numerous different communications that we've seen from various FOMC members over the past few weeks, who have been pushing back on the market, which was really originally pricing in a March cut for the first, rate cut in rates. The market's now moved beyond that, and now they're looking at maybe May or June. So, but I think essentially the Fed speak still remains pushing back on what was a pretty aggressive set of cuts priced in by the market. And I think overall, when we look at the data, the U.S. economy remains very resilient. We've seen some pretty strong data coming out in the labour market in terms of activity in a range of different indicators. And then on the other hand, of course, we have had the market looking at the issues, particularly around the regional banks. So I think there's a lot going on, and I think there's a lot for the market to digest.
There is. I mean, I'm torn between the two stools, really, between the angst over New York Bank Corp, Winnie, and this move in the Treasury auctions. Where do you come down?
So I think that this is just very indicative of where we are in the cycle. There's going to be a push and pull. Not all news is going to be good. Not all news is going to be bad. And investors have to parse out what bad news is truly idiosyncratic. And our view is that the New York Community Bank Corp issues are pretty idiosyncratic and indicative of issues within that specific bank rather than regional banks at large. And then also assess, okay, well, are valuations compensating us for that push and pull? And I think that when we talk to fixed income investors, they're looking at yields still around 4% in the long end, materially higher than that in the front end, and saying, we feel pretty comfortable at this point with where valuations are to compensate for these risks.
Yeah, I mean, these yields are going to be lucrative to the market, and the bond market faces a new test today when the U.S. Treasury holds its biggest ever 10-year debt auction. That is at 1 p.m. Eastern. Mike, I'm just recentering my time clock from the Middle East to here. I keep saying tonight, but of course it's at lunchtime today. It's going to be a beast of an auction.
Yeah, 1 p.m. today we'll get the results, Manus. And it is a record offering of 10-year notes. We're up to $42 billion. The question has been how much of all of this additional paper the U.S. has to sell because of its deficits will get taken down and at what price. So far, it doesn't look too bad. The market is still hungry for bonds. Yesterday, Janet Yellen, the Treasury Secretary, said there's a robust appetite for bonds. January global bond issuance was a record $794 billion. Treasury has now said that this is the last time they're going to increase the auction. So that takes some of the uncertainty out of what's going on for investors going forward. But as you've been talking about, we still don't know when the Fed will begin to cut rates. I want to go back to what Loretta Mester said yesterday. As you noted, she said they can gain confidence later this year before they start moving rates down. So investors still don't have a timing on that. So pricing is going to basically kind of be in the range, it appears, that it has been in. We noted 11 consecutive auctions of 10-year notes have tailed, and that's what it looks like today right now. The when issued chart shows very little spread between the two, maybe a slight tail on 10s, and that suggests that there's still appetite out there for it. One question I would ask to Winnie, because she was just quoted in a Tracy Alloway piece the other day, that the so-called new issue concession is about 3.6 basis points for all bonds this year. And I'm wondering if that's changed at all, if investors are still willing to take down without a lot of additional concession.
Well, let's just put that question, Mike McKee, thank you very much, straight to Winnie, which is, when you look at the tails, is this going to be sufficient to draw in the buyers? It's a chunky old auction, 42 billion, a record size, but this might be the peak. Winnie.
It is absolutely a record size, and we expect that the auction today is going to go relatively smoothly for a lot of the reasons that Mike was just mentioning. Investors have more confidence around the outlook for the path of rate cuts. It may not be March. It may be a little bit later in the year than the market had initially been pricing in. But at least Fed officials are kind of universally saying, okay, so at some point this year, we'll probably be able to start cutting rates. And I think that is giving investors a lot of confidence. And within the corporate credit market, we're still seeing very solid demand for new issue. Now, it varies a little bit depending on where you are across the curve. Longer duration deals have actually done very, very well compared to shorter duration deals, and also by issuer and sector. But the amount of appetite that we've seen for the new issue calendar, all the way from investment grade down to leveraged finance, including leveraged loans, has been very strong to start the year.
Well, Marilyn, you have a proclivity to be modestly long or overweight U.S. duration. Are events like today, to carry this narrative forward, idiosyncratic? We clear the decks today with the 42 billion. We move to the 30s at the latter part of the week. How important is it that the 42 billion goes off without a hitch?
I mean, we also think it's going to go pretty smoothly today. We don't see there's going to be a hitch. If there is something, then of course, we need to factor that in. But I think looking at, the trajectory that we see for rates this year, looking at the underlying economic data, looking at the demand that we're seeing from investors for the yield and the carry that you can get in the fixed income market, looking at valuations, we think now in the sort of the belly of the curve and maybe the 3 to 5 year, we think, it's pretty fair value at the moment. So we do see a lot of positives now in the fixed income market, not least being that, we can get this yield that is very attractive still, and investors can lock this in. We also do, of course, acknowledge that there's going to be a lot more supply continuing this year from treasuries, and that's going to continue, we think, to obviously keep yields up somewhat. And we are positioned effectively for a steepener in the US. But yeah, we have a pretty positive view, I would say, of being invested in fixed income right now and being, modestly long in US duration.
Tell me this. I mean, we debate the same tumble dryer issue every day. 3 rate cuts, 6 rate cuts, 3 bid, 6 offered, 3 bid, 6 offered. With bonds, I know. I mean, listen, I got to think about different ways to ask the same question every day. So have some sympathy. Am I stuck in this perilous 4 bid, 425 offered bond range on the 10s until there is actual action and I begin to understand why the Fed is cutting? Winnie. Sorry, I had to make a split decision there to come down. Winnie, take it to you quickly.
Yeah, I'm happy to take that. I think that the unfortunate truth for those of us who have to opine on the markets is, for right now, it feels like we're going to have a little bit less creative things to say because the ranges do feel narrower. And we've been talking to clients on the credit side about expect a tighter range for credit spreads this year. We've had a few years where you've seen very wide ranges in both investment grade and high yield, giving clients plenty of opportunities to buy pretty big dips and sell pretty big rallies. And it seems as if for now, as long as the Fed is on hold and investors are not anticipating that kind of big move forward in terms of cutting rates, we're probably going to be stuck in a little bit more of a range-bound market. Now, I do think that we have some potential volatility that might get thrown in as the political headlines start to heat up with the U.S. election. And as we've all learned over the past 5 years, there's always something that comes kind of out of left field that sends the market into a shock. But as we are thinking just about Fed policy and rates, it does feel like for now, expect more of a range-bound kind of tighter trading market, which is really more of a carry trade, in our opinion.
Okay, carrying clip. Marilyn, you say it pays to be flexible. With a strong focus on risk management, I'd expect nothing less. We see opportunities now in some fixed income for active managers with attractive yields. Globally, where is the most attractive to you?
So we do like a lot of relative value trades, and we're looking to really find the trades where we have the highest conviction or where we see a market dislocation. So in Europe, for example, we still like some European investment grade bonds, particularly when you hedge them back to the dollar, then you get a very nice pickup in yield. In the US, we do like areas, as we mentioned, slightly overweight US duration, but we also like areas such as healthcare services, technology, things like that. We are modestly long UK duration. And then we have a range of different trades in emerging markets, for example, in Mexico, in Brazil, and in parts of Asia as well. So at the moment, I think given the massive price repricing that we've seen over the past 18 months or so, now you really can get at the biggest price dispersion that we've seen for a long time between different issuers and different corporate bonds, different government bonds. And we do think that now you can really get at the underlying fundamentals of a name. And so, yeah, we're very diversified at the moment.
Marilyn, I'm glad you're underscoring. For an Irishman with sterling in his bank account, understanding what to do with the gilt ladder, it's important to know that that you quite like British bonds. Winnie, let me take it back to you. You are cautious, tactically cautious on credit, and I suppose is that predicated on the view that these spreads are, I mean, they're wound up like a spring. They are quite tight. Given the lack of clarity on the rest of the year, I mean, we have a no landing, soft landing scenario, but we're so juiced on these credit spreads.
Yeah, so we went out with our call for tactical caution about a week before last week's Fed meeting, as we were a little bit concerned that the very dovish sentiment that Powell conveyed in December would not be replicated at the last meeting. And that turned out to be true. We've seen some upward pressure on yields, and spreads had already reached our year-end targets for both investment grade and high yield. And we thought this is probably a good opportunity to take a little bit off the table, perhaps hedge for some seasonally technical weakness. February is historically not a great month for credit spreads. You usually see things widen out a little bit. As earnings start to roll through, we are looking to see kind of what does guidance look like for the rest of 2024, especially in some of the more consumer-aligned sectors, where you're continuing to see some issues related to consumer trade downs, especially for consumer goods. You know, how much pricing can they continue to push through, which is especially important given that we've had a recent re-rise in shipping costs, given what's going on in the Red Sea and with the Panama Canal as well.
Yeah, well, we're going to keep an eye on this commercial real estate story. I think it could be the spoiler. If you just look at some of the German names there this morning, PBB, you look at some of the Japanese names, I mean, it could be that is where the risk really lies beyond American shores in regards to the substance of any risk in commercial real estate. Winnie, Caesar, Marilyn Watson, stay with me this morning. We're going to go under the hood, have a look at some of the stocks moving before the bell. Abigail Doolittle is with me. Abby, what have we got?
Well, sticking with the theme of commercial real estate, we have wild moves for the shares of New York Community Bank Corp. Earlier, up 18% after the bank did say that deposits climbed after that dividend cut and, of course, the reserve boost, but now down 1.4%. Not so long ago, down 5%. So investors trying to decide what this means. Tesla up about 2.6% on a Bloomberg exclusive that they asked managers to make the binary decision of whether or not their employees are critical, of course, sparking layoff fears. This stock, if you can believe it, over the last year down about 6%, so clearly looking for something to stoke profitability. And then finally, Snap down 32% in the pre-market, heading toward its worst day since July of 2022. A very disappointing quarter was reported. Revenue missed $1.36 billion of the estimate of $1.38 billion. So it's interesting to see that big by diversification, I guess you would say, between Meta and Snap. Hard to predict, but right now Snap is absolutely plunging.
Yeah, it's where do you get your bang for your advertising buck, isn't it? And then you overlay the AI that Meta has to come, and that changes the dynamic. Abby, thank you very much. Coming up on the show, Secretary Janet Yellen sounding the alarm on commercial real estate.
I do have a concern about commercial real estate. I believe it's manageable, although there may be some institutions that are quite stressed by this problem.
New York Community Bank losing more than half of its market cap in about a week, down 60%, as you can see, in 7 days. That conversation coming up on Bloomberg.
I do have a concern about commercial real estate. I believe it's manageable, although there may be some institutions that are quite stressed by this problem. I don't want to comment on the situation of an individual bank, but, you know, commercial real estate is an area that we've long been aware could create financial stability risks or losses in the banking system. And this is something that requires careful supervisory attention.
The U.S. Treasury Secretary Janet Yellen there speaking in front of the House Financial Services Committee yesterday afternoon. That brings attention, of course, squarely back to New York Community Bank. Cut to junk by Moody's less than a week after it announced a surprise set of losses, cut the dividend. Moody's writing this. The move reflects, quote, multifaceted financial risk management and governance challenges facing NYCB. Meanwhile, the bank saying that deposits have climbed since the end of last year and liquidity remains ample. Katie Greifeld has the assessment on the word ample. Katie.
Well, let's start with what, of course, we heard from Secretary Yellen yesterday, of course, telling lawmakers, rather, that losses in commercial real estate, they are worried that you have this combination, this toxic brew of higher interest rates, higher vacancy rates, and also a lot of loans that are coming due. That is going to, quote, put a lot of stress on the owners of these properties. But the Secretary, she did stress that regulators are on top of it. They're working with these banks to ensure that they have adequate loan loss reserves and also the adequate liquidity levels. Their comments, of course, come as that New York Community Bank drama continues to unfold. Just to go through the timeline briefly, last week, of course, the shock, the slashing of the dividend, the stockpiling of reserves, really surprising analysts and shareholders alike. Yesterday, the stock touching its lowest level since 1997, and its credit rating cut to junk by Moody's. Today, of course, the news being that deposits have increased since the end of last year. Total deposits, $83 billion. That represents an increase from the end of 2023. And you did have the likes of Piper Sandler analysts coming out and saying that the company's liquidity and deposit positions are markedly better than almost anybody thought just yesterday. There was also some C-suite news to get to, saying that it appointed Alessandro Di Nello as executive chairman. He's going to work with the current CEO. It's getting a mixed reception, I would say, in the market right now. The stock was higher. It's a bit lower right now. It really feels like investors are just trying to assess this situation, how strong this bank truly is when it comes to fundamentals before really stepping in front of that decline.
Look, this is going to come down to how quickly deposits leave the bank and whether there's a liquidity issue. We're not there yet, is our understanding. Katie Greifeld with the very latest on New York Bancorp. Winnie Caesar, Marilyn Watson are my guests this morning. Winnie, to you, fill or kill on this. Everybody's saying it's idiosyncratic. Treasury Secretary's not that worried. And one or two guests have said to me, to lose one or two banks won't be a big problem for the market. Are you as insouciant?
I mean, I would say that we take any sort of bank stress or potential bank failure as a very serious issue, but it is an unfortunate consequence, oftentimes, of rate hiking cycles, of tightening in financial conditions to see stress within banks. And I think that this was amplified by some of the dynamics within the Treasury market, longer duration securities having, pretty significant mark-to-market losses, and also just the news that focused on a lot of these banks. It can become kind of a vicious spiral of deposit outflows, but we haven't seen that with New York Community Bank, which is relatively encouraging.
Marilyn, I mean, lots of people have come on the show and they've said, regional banks have 6.5% exposure to CRE. Don't worry about it. Are you?
Not overall, no. So we actually think that, overall regional banks in the US, we think are actually in a better position than they were last year. This particular bank is in a way unique in terms of its high concentration in the New York area and in commercial real estate. There are obviously some issues more broadly around the global real estate market and commercial real estate, particularly with whether people go back to the offices or not. In many areas, not so much. So there are a lot of issues around commercial real estate. But I think in this particular instance, this bank has also obviously rapidly grown its balance sheet, particularly after taking over Signature Bank last year. So I think this is more of a unique case. And overall, we do think that the regional banks are in better shape, but it's something that obviously we're keeping our eye on.
Yep, and you make it very, very clear, of course, about the geography involved in this. Ladies, thank you very much for your thoughts on the markets this morning. Winnie Caesar, Marilyn Watson, my guests. And just a reminder of what Neil Kashkari has had to say. He sees 2 to 3 rate cuts as being appropriate in 2024 and a few more months of data. Now you got the qualification. That gives them confidence. Coming up in the show, Morning Calls, Morgan Stanley's Andrew Sliman joins me around the opening bell on why he sees gut checks ahead in equities. This is Bloomberg. Yield hunters of the world, roll up, roll up. I'm selling some 10-year paper, not me, the Treasury, are $42 billion worth of paper. It's history in the making. There was enough appetite to come in and pick up the short-dated paper there. Are you lively enough to pick up duration? We'll wait for the results on that. Time now for your morning calls on what the scribes are writing on Wall Street. JP Morgan downgrades New York Community Bancorp to neutral, saying the departure of key executives heightens investor concerns. Next up, Citi downgrades Steve Madden to neutral, saying headwinds from higher freight costs could weigh on earnings. And finally, wrapping it up, Morgan Stanley upgrades Hermes to overweight. Why not have a Birkin? The reason why they're all clapping is, of course, equity markets are bid up. There is no fear in the equity market from this bond market and the rise in yields. We gave 8 basis points back yesterday across the curve. You're looking at equities going for a slightly higher opening. Tesla is bid up. May there be a restructuring and job cuts there? This is the opening bell. We've got a positive day on equities. We're waiting for a record auction in the size of $42 billion. I mentioned that to you a little bit earlier on the 10-year government bond paper. Now, the euro is up by 1/3 of 1%, squeezing a little bit higher. Could it be they get weak German data? We're waiting for the 10-year auction as well. So more pressure on the ECB to come, possibly. Bond yields pipping up by 1 pip. Don't call that a move, just call that flat. Crude up by 0.4% at 73.66. Caught in a bandwidth of $10 so far this year. One stock on the move. It's really in our focus. The New York Community Bancorp. The lender was cut by Moody's less than a week after slashing the payouts and stockpiling reserves, putting more concern about the commercial real estate market in our mind's eye. Abigail Doolittle has the carry through on Moody's cut.
Yeah, a lot of wild trading here. So after that downgrade, and that, of course, was after yesterday when the stock was at its lowest level since 1997, basically down 60% since reporting last week when they talked about building their reserves 12 times over what was expected, 12 times over expected to potentially cover for bad real estate loans, commercial real estate loans. The stock down 60%, trying to catch a falling knife. Investors really not doing a good job. Then that Moody's cut yesterday, and then today the company coming out perhaps trying to reassure investors, saying that bank deposits actually climbed, that total liquidity of $37.3 billion exceeded uninsured deposits of about $22.9 billion. Total deposits of $83 billion represent an increase from the end of last year. So when this news initially came out this morning in the pre-market, as you know, Manus, the stock had been up about 18%. Not so long ago, it was down about 5%. Right now, up about 1%. Investors really don't know. They just don't know how severe that exposure is to commercial real estate in terms of office and multifamily. From a chart perspective, as I mentioned, it is truly trying to catch a falling knife, a difficult way to invest. It may take quite some time for these shares to stabilize.
Abby, thank you very much. A lot of put option buying on those stock yesterday, going for management changes. Let's flick across to Snap. The stock is falling. It's struggling. It's struggling in the ad market. There's a slump there. Disappointing on the revenue side in the holiday season. Ed Ludlow has the dissection. So, Ed, this comes down to where do you spend your ad dollars, on Instagram or Snap?
Not on Snap. I mean, they had top-line growth of 5% to $1.36 billion. The street was looking for $1.38 billion, so a small miss. The stock's down almost 32%, which puts it on track for its biggest decline since October 2022. But the context here is like Snap has done this big reshuffle within its business. Even as recently as Monday, they announced more layoffs. But if you look at the bottom line, they had an adjusted EBIT loss of $55 million to $95 million. So part of this is the street saying, well, you've been rethinking your ad platform over the last 12 months. You've taken the painful decision to do layoffs already in the last 12 months. You're doing more. That's not showing up in the bottom line either. Overall, active users grew 10%, but they grew in those core markets like North America and Western Europe. The problem is the story for Snap's been the opposite. They put a lot of time and money over the last couple of years saying, we're going after emerging markets because we think we can grow the user base there and we think we can get ad pricing power there as well. That's not worked, and now they're pivoting back. But it's a pretty big move. 30% on what's already a pretty shrunk company, Manus. I don't know if you're still on Snap these days, but you're completely right. In the fight for eyeballs, the money ain't going to Snap.
Oh, Ed, I'm feeding that many platforms at the moment. Apparently do quite well on corporate TikTok, so I'm gonna adopt that on a personal basis now. Apparently so. Rumour has it in the newsroom. Ed, thank you very much. Ed Ludlow, who would have thought I could be big on TikTok? Talking about bonds, desperate times. Let's talk about automakers. Ford beats on expectations. You got new forecasts, higher profits to come in 2024. You got it, due to EV losses and labour costs. So there's big issues to deal with, Isabella Lee, aren't there?
There are big issues, but for now, investors are cheering the report. We're seeing the stock up around 7.5%. That's on track to reach a 6-month high. The company posted adjusted EPS of 29 cents. That's more than double analysts expected. And fourth quarter revenue also came in at $46 billion. That's also well above estimates. We have CEO Jim Farley saying, we are nowhere near our earnings potential. And to your point, there are big issues. This includes EV sales are slowing, and this seems to be a theme now. Yesterday, we had a Hertz reporting, and they also mentioned that same issue. And this forces companies to be more nimble. So Ford, for instance, is looking to balance scaling back their EV production while also dialing up output of their traditional industrial combustion engine models. And Ford is also looking to develop smaller, cheaper EV vehicles. That's to compete with Chinese models and also Tesla. And a bright spot, though, is hybrid gas EVs. Ford expects those sales to grow 40%. For 2024, Ford expects earnings of $10 billion to $12 billion. That's on the higher end of their November target. And the automaker is giving investors a supplemental dividend of 18 cents a share. That's on top of the 15 cents regular quarterly dividend. Manus.
Well, it's bid up this morning, up 6%. Isabel, thank you very much. Let's turn to the ride-sharing space now. Uber reported gross bookings that beat estimates, showing strong global demand for rides and food delivery. Katie Greifeld has the latest. Katie.
Yeah, man, it turns out people are still hailing rides and also ordering food. You take a look at gross bookings that clocked in at $37.6 billion in the quarter ended at the end of last year. Analysts had been expecting $37.1 billion on average, so a beat there. For the current period, also a rosy outlook there, forecasting bookings between $37 billion to $38.5 billion. The midpoint of that range slightly above the average estimate of $37.3 billion. You also had Uber CEO taking a bit of a victory lap, saying, quote, it was a standout quarter to cap off a standout year, but shareholders not as impressed right now. You can see this stock is currently down almost 2%, and that's simply because the bar was so high. Uber shares have just about doubled over the past year. They hit a record high in the run-up to these results, and they have also crushed their biggest rival, Lyft. But looking forward, the company did say that it's going to proceed with an earlier pledge to return capital to shareholders. It's going to provide more details on those plans at an investor event next week. So stay tuned, Manus.
Okay. Now that I've arrived in New York, I just added to the Uber gross margin and gross revenue. Katie, thank you very much. Well, Morgan Stanley's Andrew Slimman looks into what to expect for this year. Breadth is narrowing. To me, the market is looking tired, and that alone is a reason to be more cautious. However, I don't expect more of a correction until later in the year. Good to see you this morning, Andrew. Cautious. What does cautious equate to in terms of action? What level or gravity of caution do you have? Good morning.
Good morning. Yeah, look, I mean, the market has rallied 20% off the October low. It's been up 13 out of 14 weeks. And I think the market and the breadth is narrowing. It's a sign of the market tiring. So maybe when we hit 5,000, which is right around the corner, that the market takes a breather. Could we get, a 5 to 10% correction off that level? I think it's possible, but I expect more of a pullback later in the year, because I don't see kind of the fundamental framework to cause a bigger pullback right now than just we've had a very good run, and investors might be looking to cash in a little bit.
Now, look, I mean, it's an old saying, a man that tires of London is tired of life, but a man that tires of big tech must surely be challenged. Now, you're not exactly tiring on big tech, but you are still, very strongly biased towards the Microsoft, the Apple, the Alpha. I was looking at your fund.
Sure.
Are there, if you were to take a traffic light system to that, where are you? Still full green, quasi-amber, but certainly not red?
Yeah, I mean, I think it's important to take a step back. I mean, what drives stocks is earnings and earnings revisions. That's the important thing. Where are the positive revisions coming? And boy, oh boy, they're coming in a lot of different industries right now. And one of them is in tech. Now, as we all, lots been, discussed, it's no longer the Magnificent Seven. There is bifurcation going on, but largely these companies continue to report excellent quarters, generating a lot of cash flow. So I don't think it makes sense to, sell them and look elsewhere. I think it's been a mistake until companies really express more cautious, and we're just not seeing it. So my correction is maybe you trade, take a little bit off these positions, but I think they'll be higher by year end.
When you look at so much of this risk, proclivity for risk, we started with one of the worst years for risk across assets since like the late 1990s. Here we are, we're a month into 2024. When you stand back and you look at risk, do you just incrementally deploy because to fight this momentum in the market is perhaps folly?
Yeah, no, well, it depends. I mean, it depends really what the time frame that you're talking. Look,
okay.
The time to act, I was very convinced, and I articulated on these shows that the market was going to rally in the fourth quarter, because it takes a year of investors selling off the low until they flip and they start buying. And that's always been the case. And last year, the bears, kept fighting it. People kept selling. The market rallied because companies were buying back stock, and they flipped in the fourth quarter. So it was a time to add a lot of risk, was really going into October of last year on a short-term basis. I think now It is a time to be short-term cautious on risk. So I would look at the high beta stocks that have done very well and maybe take some money out of them. But to your question, look, investors only started buying into the market in the fourth quarter, in my belief. And that's going to continue this year. Sentiment is going to, cash is going to follow sentiment. And I think it's going to be a good year for markets. But you have to be more, respectful of the fact that last year there was very little volatility in the market. The VIX stayed, very low. Markets went up 8 out of 12 months. There were a lot of people screaming it wasn't going to happen, but the market pretty much went straight up. And so I think, reversion to the mean means more volatility this year.
Tell me,
the bears will have a better day at times, but it will be a higher by year end.
Look, I'm just looking at the headline that we've just popped on NYCB. This isn't to dig into the story on NYCB. This is to dig into the conversations. To what extent are people talking about this in your shop and on the street? What is the market saying, Andrew, about NYCB and the idiosyncratic nature of it, the New York nature of it? Can it be a spoiler? Can it be a grey swan that morphs into something? The German stocks are under pressure. Japanese stocks are under pressure. The New York stock is under pressure. This is idiosyncratic or something a little bit more humorous?
Very good question. But if you ask me what the market is saying, the market is saying it's idiosyncratic because the market's hitting it all. It's close to 5,000.
Do you doubt that?
The market.
You've lived through a few cycles with me. Do you doubt that?
Absolutely. I think there are reasons to actually be optimistic on financials. I'm just not sure of the regionals. I know that there's going to be more volatility. This year. That I'm confident. Could this cause more volatility? Yes. Is this going to cause a systemic problem throughout financials? I do not believe so. But, again, I know there's going to be more volatility. You tell me what's going to cause it. Could this be it? Sure.
You probably quite like the volatility. I'm curious to know, I know that you can talk about Microsoft specifically. I mean, Satya Nadella puts his anchor down on India. It's gone to a $3 trillion market valuation under him. And again, he talks about the AI opportunities. Does its magnificence just shine within the Mag 7?
Well, I mean, maybe I'm just not that, tech savvy, but I can understand the Microsoft story, which is you have Windows, you want Copilot, it's going to cost you more. And the estimates for this year and next year in terms of the absorption of Copilot is relatively muted. And I think it's going to be rolled out much more. They're very quiet right now in terms of actual numbers. As the year progresses, I think we're going to learn. More people are using Copilot than are currently in the estimate. So that's a reason to stay long that. But I think there are plenty of value areas, industrials, in financials, in the market for opportunity. So I like a balance between growth and value stocks this year.
I'll leave you with this thought from Nadella, okay? I have never seen a rate of diffusion of any technology like this in the 70-year-long computer age. We all need to go back and read Greenspan's speech on paradigm shifts in technology, putting it out there. Andrew, thank you very much. Andrew Sliman there of Morgan Stanley on the calls in the market. Coming up, President Biden plays the blame game.
Now, all indications are this bill won't even move forward to the Senate floor. Why? A simple reason. Donald Trump.
The bipartisan bill on the border security and aid for Ukraine set to fail. The conversation with Amy Hordan.
The result of all this hard work is a bipartisan agreement that represents the most fair, humane reforms in our immigration system in a long time, and the toughest set of reforms to secure the border ever. Now, All indications are this bill won't even move forward to the Senate floor. Why? A simple reason. Donald Trump. Because Donald Trump thinks it's bad for him politically.
The latest U.S. border deal on the brink of collapse. President Biden there placing the blame squarely on the Republican presidential frontrunner Donald Trump. Biden says that Trump pressured members of the GOP to reject the bipartisan immigration bill that included aid for Ukraine. Amory Hordown has been tracking this. It's a bit of a high-risk strategy, isn't it, for this blame game straight off the pulpit? But where are we in this? I mean, this bill is all but dead.
All but dead. There'll be a vote today, and it's likely to fail. And then what Senator Schumer is likely going to do, according to our reporting and some other reports out there, is going to basically test the waters with another motion on the floor to see if he can get the aid through for Ukraine,
So
Israel,
that would be a clean
and Taiwan.
bill.
It wouldn't include the border. But the issue is, if this is able to pass in the Senate, which the Democrats have control, and there are a lot of also defense hawks in the Senate that want to see aid to Ukraine, want to see aid to Israel, want to see aid to American partners in the Indo-Pacific, if it's able to pass in the Senate, there's still a question of whether or not this could pass through the House of Representatives, and Speaker Johnson could put this on the floor. The Republicans have really come out in the past few months and said no more aid to, say, Ukraine without fixing the U.S. southern border. And now it looks like these two issues have to be delinked because Republicans in the Senate do not like this current border deal that you just heard the president talk about. And he's saying that if that doesn't pass, which it's not going to, he will make it an election issue. It's funny because they both want to make immigration election issue.
But can this country run for another 6-7 months with I'm not saying an open border, I'm just saying a less
overwhelmed border.
An overwhelmed border. Thank you for helping me. But in the end of the day, 6 out of the 10 swing states put the blame at Biden's door for this migrant crisis. He needs a fix.
Well, this is why the former president, Donald Trump, said this would be a gift to Democrats. He's looking at the same polling we are. The latest NBC News poll over the weekend showed there's a 30-point margin to Trump's favor when it comes to who would be better when it comes to immigration and the southern border. I was really taken with the fact that the border union and the southern border, who endorsed former President Donald Trump, says this is a good deal and they should put it on the floor and they should vote for it. This is where it becomes a little bit of policy versus politics.
Of course. Well, that's the same in every capital in the world. Talk to me about Haley in Nevada. I mean, she scored less than tick the box for none of the above candidates.
Right. Nevada's
What does that mean? You're going to say it's idiosyncratic and I shouldn't get too heated up about it?
No. I mean, Nikki Haley has a really, really steep path forward. It's all but done to be Trump's for the nominee, especially when you look at her home state where she's 20, 30 points behind the former president. Nevada was a little bit interesting because she ran on the primary and Trump's name was not on the primary. He's going to do the caucus, and it's pretty much all for him. But the optics of it are embarrassing.
Does she drop out before? Does she drop out? What are people saying to you in Washington?
Nikki Haley wants to go to her home state, and she will continue to fundraise until she gets to her home state of South Carolina, and that's the one to look for.
Okay. Amory Hordown, thank you very much, keeping it real on the political front. Let's get some sector price action for you. It is an equity market show after all. Abigail Doolittle is with me. Politics and equities. What better can you ask for?
Absolutely. And the stock side of it, we're looking at gains for the S&P 500 up about 0.4%, up for a second day in a row. Most sectors are higher, so it is a broad-based gain. Communication services up about 0.7%, the best sector. Meta, the best stock in that sector. To the downside, though, real estate down 0.4%. And of course, you know, we have New York Community Bank Corp reopening. It had been halted, Manus, after all the volatility we were talking about before. It initially opened up down 10%. Now it's down 6%. So investors really uncertain. Now, it's interesting because if we take a look at the real estate index on the year, it is down 5% too. That's not a direct reflection of anything happening with NYCB. These are REITs and there's a lot of very solid companies in there, but just the fallout fear, the contagion fear taking this sector down, even though yields are much lower than they had been last year. So stay tuned on this one for sure, Manus.
Abby, thank you very much. Abigail Doolittle. Coming up in the show, market moving events to set your clock by. It is your trading diary on Bloomberg. There are no nerves in this equity market. You've got the Russell down by 0.6%. We're waiting for the biggest 10-year bond auction ever. So there are no nerves in the equity market for the big bond auction to come. We'll bring you those results with the tail, if there is one, a little bit later on. Set your agenda. This is Fed Speak Week, and it kicks off 11 a.m. today. We'll hear from Collins, Barkin, and Bowman. As I said, 42 billion of 10-year paper comes down the pike at 1 p.m. And Disney, a whole new world. The results will come after the closing bell. Thursday, Janet Yellen will speak again, testifying in the Senate. And Friday, it is about the CPI revisions. Right now, these equity markets are resilient. That was Countdown to the Open, and this is Bloomberg.